I want you, as an investor, to just consider a single company for a moment.
Okay.
A company that generated $10.6 billion in free cash flow last quarter.
An incredible display of operational strength.
Exactly, a staggering amount. Yet at the very same time, this same company has a division inside it, just one, with over $73 billion in cumulative losses.
It's extreme tension, isn't it?
It is. That tension, the immense profitability of the present versus the astronomical cost of the future, that, in my analysis, is the single most important factor for Meta platforms right now.
Welcome to DeepResearchGlobal.com podcast.
Today, I'm sharing my comprehensive analysis of Meta platforms as we head into 2026.
And my goal here is to really synthesize the strategic positioning, the vulnerabilities, and, the growth vectors that are going to shape its financial path.
I believe this is a true inflection point for Meta.
It really is. We're examining how the company is trying to balance this dominant core advertising business, which is the cash engine, with these hugely aggressive, and I mean tremendously expensive, investments in AI and immersive tech.
Right. And this assessment is really designed for sophisticated investors who need absolute clarity on these enormous capital allocation trade-offs.
So my starting point, where any sound analysis really has to begin, is with the scale of the platform.
The sheer scale. It's not just a big number, is it? It's their most formidable competitive advantage.
It's the moat, a deep, unshakable moat that creates these substantial barriers to entry for anyone.
So what are the numbers we're looking at? Because they're almost hard to believe.
They really are. I mean, the reach is unprecedented. I'm looking at data from September 2025, and it shows over 3.5 billion daily active people. Daily active people across their entire family of applications. That family DAP number is it's critical. It's a global digital population they essentially control.
No one else in history has had that kind of sustained daily engagement.
No one. And I think we need to pause on the composition of that reach. My analysis shows Meta owns 4 of the biggest social media platforms on the planet.
Right, and 3 of them are just giants in their own right.
They are Facebook, WhatsApp, and Instagram. Each one exceeds 3 billion monthly active users.
Think about that. Facebook is at 3 billion MAU, WhatsApp is at 3 billion MAU, and so is Instagram.
It's not just global coverage, it's market saturation in the truest sense.
So for an investor, what's the relevance of that scale? How does it translate?
It's everything, for 2 main reasons. First, that huge user base gives them an unparalleled data advantage for ad targeting.
Which means higher ROI for advertisers.
Exactly. Higher ROI, which lets Meta command premium pricing. And second, and this is becoming more and more vital, that enormous data set is the essential fuel needed for training their advanced AI models.
The very models they're spending tens of billions on.
Precisely. The data advantage becomes an AI competitive advantage.
Absolutely. The size of the data set is the training differentiator. If you don't have the data, you just can't build the model that wins. So let's pivot that scale to the money-making engine itself, the cash register. My analysis shows the core ad business is, it's profoundly resilient.
Unbelievably so, given the market maturity. In Q3 2025, the family of apps advertising revenue hit $50.1 billion.
$50 billion in a single quarter.
And that number represents a very strong 26% year-over-year increase.
So when you assess the health of a giant like this, what are you looking for?
I look for 2 things: signs of saturation and pricing power.
And what's so fascinating here, based on my internal analysis, is that the 26% growth wasn't just them squeezing more money out of existing ad space.
Which would be a bad sign, a signal of a saturated platform.
Right. But my data shows it was a balanced mix. It was volume and price. Ad impressions were up a significant 14%.
Which tells you engagement and inventory are still growing.
Exactly. And at the same time, the average price per ad was up 10%. That shows strong demand and better monetization, especially from things like Reels.
So based on that momentum, my research projects that Meta will generate over $150 billion in advertising revenue by 2026.
Which would absolutely cement their dominant share of the global digital ad market.
Right. This core competency is the reason the stock has its valuation premium.
And I really need to draw your attention to the cash generation here, because this is what funds everything else.
It's the war chest.
It is. Despite all these massive investments we're about to get into, the company generated $10.6 billion in free cash flow in Q3 alone.
And that's happening while they are funding a multi-billion-dollar loss-making division.
Right. And on top of that, they have a remarkably strong balance sheet. My records show $44.4 billion in cash and marketable securities as of September.
And that financial strength, that consistent flood of cash, is precisely what allows them to have this aggressive long-term strategy.
Without that dominant core engine, these massive bets they're making on AI and the metaverse, shareholders would never tolerate it.
The core isn't just profitable, it's defensively dominant.
Okay, so now we have to transition to where that core strength is being tested. This is the central vulnerability, the investment paradox.
The need to invest in AI is creating these unprecedented demands for capital expenditure, CapEx.
And you, as an investor, you must factor these demands into your valuation models right now?
Because they fundamentally change the short-term free cash flow calculation.
Look at the sheer scale of this commitment. Meta raised its 2025 CapEx guidance to, a range of $70 to $72 billion?
70 to 72 billion, yes. And that's up dramatically from an already huge number. When I analyze the drivers, it's all about AI infrastructure.
Building new data centers.
Building massive data centers and critically securing GPU procurement. The competition there with Microsoft and Google is just fierce.
But the truly staggering number, the real warning sign for anyone modeling 2026, it came from the CFO, Susan Lai.
Right. She gave a very explicit warning. She said, "My current expectation is that CapEx dollar growth will be notably larger in 2026 than 2025.
Notably larger. When I analyze that statement, it suggests 2026 spending could potentially go past $100 billion.
An astronomical figure. It's going to weigh so heavily on near-term profitability and decelerate free cash flow. You have to trust that the eventual ROI will be there.
So I asked myself and my clients, why? Why is management willingly compressing their own margins like this?
Because the spending is strategic. It's driven by what they see as an existential necessity.
They're aiming for leadership in open source AI.
Exactly. With the Llama family of models, they are choosing long-term competitive positioning over the immediate gratification of a perfect quarterly margin. It's a deliberate trade-off.
And we saw a huge, almost shocking example of this back in June 2025.
Right, the largest external AI investment they've ever made.
A staggering $14.3 billion into scale AI.
And I see this not just as spending, but as a strategic move to vertically integrate their AI development pipeline.
It was all about data labeling capabilities, right?
Specifically, because high-quality data labeling is the bottleneck in training these very advanced AI models. By securing that pipeline, they reduce dependency and accelerate their own launches.
And the vision from the top, from Zuckerberg, it's not just ambitious. He's staking the company's entire future on this.
His Q3 statement had two huge goals. First, he expects Meta AI to become the leading assistant globally, serving over 1 billion people by the end of 2025.
1 billion people.
And second, he's betting that their next model, Llama 4, will become the leading state-of-the-art model in the world.
So the massive CapEx.
Yeah.
It's the price they're willing to pay for a chance at that dominance.
Exactly.
That
Despite all that strategic hope around AI, we cannot avoid the biggest, most persistent financial drag on the entire company.
Reality Labs.
Reality Labs, the metaverse bet. And it just continues to absorb capital at a rate that worries even the most patient investors.
When I look at Reality Labs, I see a financial sinkhole.
The scale of the loss is hard to defend. In Q3 2025, it posted a $4.4 billion operating loss.
And what's concerning to my analysts is that this loss rate, it's just held flat year over year.
Right. There are no immediate signs of improvement. The burn rate is constant.
And if we step back, the cumulative impact is even worse.
The company has accrued cumulative losses in that one division since 2020 that now exceed $73 billion.
$73 billion. And industry analysis projects that the full year loss for 2025 will be over $17 billion.
And the critical problem for investors is that there is no clear path, no timeline from management for when this division might become profitable. It's just a massive, indefinite R&D drain.
However, I always look for the nuances, and I do urge investors to note that even within this drain, there is one genuinely successful area that's starting to emerge.
AI-powered glasses.
Exactly. The overall Reality Labs revenue, which often gets discussed, actually hit $470 million in Q3.
And importantly, that was up 74% year over year.
My analysis shows that growth was driven almost entirely by strong sales of their Ray-Ban and Oakley smart glasses, which are integrated with Meta AI.
So that suggests a potential near-term revenue stream from the intersection of AI and wearables, a bit of a pivot away from just expensive VR headsets.
It's a glimmer of hope, at least, that the investment is creating some tangible products that people want.
Moving on to the threats and vulnerabilities. The core financial strength is there, it's undeniable, but these rising expenses are definitely eating into profitability.
Which brings us right to operating margin compression, something every investor needs to be tracking very closely.
My data confirms that pressure. Meta's operating margin declined to 40% in Q3 2025.
Down from 43% the year before.
Right. And that drop directly reflects the impact of those aggressive AI investments we just talked about.
But the real danger is when the expense trajectory outruns the revenue. And I look at these numbers and see a lot of pressure ahead.
Total expenses increased 32% year over year to $30.7 billion.
Notice that outpaced the 26% revenue growth. And when costs grow faster than revenue, margins have to decline. It's financial gravity.
And the prognosis for 2026, based on what management is saying, is just as cautionary. The CFO explicitly warned that next year we'll see total expenses grow at a significantly faster percentage rate than 2025.
So my advice to investors is to expect continued, maybe even accelerated, margin pressure.
Until these huge CapEx investments start to generate real revenue. The question is, can they keep operating margins above 35%? If they dip below that, my bear case analysis gets a lot sharper.
Okay, beyond internal costs, let's talk about regulatory risk. It remains this persistent dark cloud over Meta.
Especially concerning future revenue streams. It's a major tangible threat to the business model itself.
In the EU, the situation is particularly complicated.
It is. They're navigating really stringent requirements around data privacy, competition, the Digital Markets Act.
And what's critical for investors to watch is the EU's review of their proposed less personalized ads offering.
Right, because that review carries the potential for a significant negative impact on European revenue. If the EU forces a radical change there, a huge chunk of their revenue could be at risk.
And then on the home front, in the US, the litigation risk is very high.
Immense downside potential. You have to watch the multiple youth-related trials that are scheduled for 2026.
These cases pose a real threat of material loss. And that could mean two things, right?
It could. It could mean enormous financial penalties or even more damaging, mandated operational changes that restrict their core features.
And globally, I just see ongoing challenges everywhere. Data localization requirements, content moderation obligations, antitrust investigations.
It all drains management's attention and resources. It distracts them from product innovation. And that drag should be factored into any valuation.
And finally, there are the competitive pressures. Despite Meta's huge scale, it still faces a formidable threat from TikTok.
TikTok now reaches 1.6 billion users globally. And my data shows it maintains incredibly strong engagement with younger demographics, the audience that dictates future ad trends.
And it's not just about eyeballs, is it? It's about the fundamental technology. TikTok's algorithm poses a structural challenge to Meta's old social graph model.
It really does. I also have to highlight the risk that comes with advertising concentration. Meta is overwhelmingly dependent on ads.
Something like 98% of total revenue.
Which makes them highly vulnerable to economic downturns when marketing budgets get cut first and to regulatory changes.
Any shock to the ad market just hits Meta disproportionately hard.
And speaking of data access, platform-level privacy changes are a huge headwind. Apple's ATP framework already had a big impact.
Right, and Google's plan to get rid of third-party cookies continues to constrain ad targeting. It creates this kind of blind spot for advertisers.
Meta's investing heavily to adapt, to build new privacy-preserving tech. But that transition creates a lot of uncertainty about the long-term effectiveness of their ads.
They're basically having to re-engineer their core product on the fly.
Now let's pivot to the upside. Because that monumental CapEx spend, that $100 billion projection, it's all based on new monetization pathways.
Right. So the monetization of new AI products and services is maybe the most exciting, but also the most unproven opportunity they have.
I see the immediate potential coming from two areas. First, that conversational assistant, Meta AI.
Which they're targeting to reach over 1 billion users by 2025.
If they hit that target, they instantly create a massive new commercial funnel, opportunities for sponsored interactions, premium features, maybe even enterprise licensing.
And the second major AI opportunity is in the Llama ecosystem.
Yes. the open source nature of it. My analysis shows these models are gaining developer adoption at a very high velocity.
And that adoption provides a powerful commercial path.
It could translate into new revenue from cloud services, from high-value enterprise partnerships, from embedded AI solutions across Meta's entire product portfolio.
So it's an attempt to build a platform moat, not just a product moat.
Exactly. And, international expansion is another key growth vector that often gets overshadowed by all the AI headlines.
Especially in emerging markets and business messaging.
The numbers in Asia-Pacific are compelling. My models show video ad revenues there rising from about $4 billion in 2025 to over $6 billion by 2030.
A huge population that's rapidly digitalizing. It's structurally undermonetized compared to North America.
And this brings us back to those key assets that are still significantly undermonetized: WhatsApp Business and Messenger.
My research identifies India as a key strategic market for them to unlock that, $10 billion global business messaging opportunity?
$10 billion. And this is a fundamentally different type of revenue than just display ads.
I see the path clearly here. It's about integrating payments, shopping features, sophisticated customer service tools right inside the messaging platforms.
And that creates crucial new B2B revenue streams. It's the diversification they need, especially with all the regulatory pressure on their core ad business.
And finally, you have to acknowledge the overall market momentum. The whole digital ad market is growing, and that's a powerful tailwind for Meta.
Global digital ad spending is expected to rise about 7.4%. to reach $1.7 trillion in 2025.
A massive market. And Meta, with its scale and data, is just perfectly positioned to capture an outsized share of that growth.
The confidence is there. You see it in the 14% increase in ad impressions. They're gaining inventory. The market's growing.
Right.
That's a powerful combination.
And let's not overlook their internal product victory with Reels.
Right. They've successfully improved the monetization of their short-form video product on both Facebook and Instagram.
It's not just a defensive move against TikTok anymore?
No, it's a rapidly growing high-engagement revenue stream that lets them compete directly and very effectively.
Okay, so to synthesize all of this, investors really need to understand the central, almost brutal conflict in capital allocation that's happening right now.
It is the heart of the investment dilemma.
I see management doing this high-stakes juggling act. They're trying to manage 4 massive competing priorities at the same time.
All of them drawing from that same finite free cash flow engine.
First, you have the AI infrastructure, massive CapEx for competitive positioning. Second, Reality Labs, the long-term vision with guaranteed high losses.
Third, core product innovation. Just the maintenance needed to keep Facebook, Instagram, and WhatsApp dominant. And fourth, shareholder returns.
And I want to highlight that shareholder return part, because it proves how profitable the core business is.
Right. Even with the rising CapEx, they still manage $3.2 billion in share buybacks and $1.3 billion in dividends in Q3.
So the strategy is clearly prioritizing aggressive long-term bets over immediate margin optimization.
But they're trying to balance that with enough capital return to keep investors on board. It's a very delicate act.
So if we move to valuation, my analysis and the current market consensus actually suggests a lot of confidence in that long-term story.
It's surprisingly bullish, considering the CapEx outlook. 41 analysts currently rate Meta as a buy. The consensus price prediction is $829 for 2025.
And Morningstar considers the company moderately undervalued compared to their fair value estimate of $850.
The market is pricing in a lot of future success from that AI bet.
So let's break down the bull case. What does it rely on?
I see it centered on the core advertising business, staying highly profitable, with growth above 20%. The AI investments, if they work, create powerful new moats. And the huge user base is a durable advantage.
So the bullish argument is essentially the current pain is justified by the future dominance these investments will buy.
Exactly. Conversely, the bear case, which I have to detail for my clients, hinges on a few critical risks actually happening.
Right. The first is that the escalating CapEx just compresses margins without a guaranteed return.
They spend $100 billion and don't achieve dominance with Llama 4. Second, regulatory actions severely impact the ad business. And third, Reality Labs' losses just continue indefinitely.
A permanent multi-billion-dollar drag. I ask, if CapEx hits $100 billion and Reality Labs' losses stay constant, isn't Meta just burning cash to buy time?
That is the bear's central thesis.
So to help investors monitor this, for the next 12 to 24 months, I'm urging them to track 6 key metrics.
Okay, first, watch the advertising revenue growth rates. We need to see that core growth stay robustly above 20%.
Second, monitor operating margin trends. Can management keep margins above 35% despite the rising costs? That's the financial line in the sand.
Third, track the Reality Labs trajectory. Is there any clear progress toward profitability or at least a plan to limit the financial bleed?
Fourth, look for early, concrete signs of AI monetization. We need specific revenue contributions from new AI products, not just adoption numbers.
Fifth, monitor regulatory outcomes with extreme prejudice, specifically the EU ads review and the U.S. youth litigation.
And finally, we have to assess capital efficiency. What measurable returns are being generated from these massive infrastructure investments? That efficiency metric will define the long-term performance of the stock.
My final thought is this. Meta enters 2026 from a position of profound core strength. Unparalleled scale, robust cash generation. It's unquestionable.
However, it is simultaneously taking a calculated, enormous, and possibly irreversible bet on the future through AI and immersive computing.
The next 2 years will be absolutely critical. They will determine if these substantial margin-compressing investments actually translate into new competitive advantages and new revenue streams.
Or, conversely, if they simply lead to irreversible margin compression that destroys short-term value without delivering on that promised future.
Investors are fundamentally betting on management's history of making bold, long-term decisions. Execution under the weight of this unprecedented spending is everything now.
Thank you for listening. Subscribe to deepresearchglobal.com for more latest business news briefs, company analysis, and investment insights.